Hello, and welcome to all the participants who have joined. It's a bit late in the evening for the participant joining from India and elsewhere in Asia. Thank you so much. Welcome to today's practitioners webinar, Venture Capital Amid Huge Macro Opportunities, Funding Slowdowns, and High-Profile Failures, hosted by CFA Institute. At first, I would like to take a moment to welcome our audience from around the world joining us for this webinar. I am Pankaj Sharma, moderator for this event, and I lead capital market policy for CFA Institute India. In my role, I am responsible for advocating policy positions on issues that concern Indian capital markets and stakeholders across a broad range of issues. Before I introduce our speaker, I have a couple of housekeeping points. Today's webinar is scheduled for 60 minutes, including Q&A, 40-45 minutes for the conversation with the speaker, and then 15-20 minutes for the question and answers. We'll be leaving ample time for Q&A, so please feel free to submit your questions throughout the presentation. You can do so by clicking on the Q&A icon at the bottom of your viewer and typing your question in the box. We immensely value your feedback, so please complete the evaluation survey before you sign off today. Now it's my pleasure to introduce our speaker for today's webinar, Mr. Rutvik Doshi. Mr. Rutvik Doshi is the general partner at Athera Venture Partners. His experience is so rich and he has done so many interesting things with several accomplishments in his career so far that for me, it is impossible to cover all of that, but I'll still give it a try. To begin with, he has more than 23 years of professional experience, during which he successfully transitioned to early stage venture investing about a decade ago. Following his 12 years of experience in the technology space, Mr. Doshi has participated in India's fast emerging internet ecosystem, first with Google, where he launched and managed several products, including voice search, Google mobile app, SMS channels, and Google News globally, followed by an entrepreneurial stint as the CEO of an e-commerce startup, Taggle, in Bangalore. Before Google, he spent 6 years in the United States building an internet management software for CA technologies and a startup. He holds 6 patents in web application and infrastructure products. He joined Athera. It was called Inventors India back in 2012 then, and he has been on board of many companies and observer for many of the investee companies for the Athera Ventures. Mr. Doshi holds a Bachelor's of Technology degree from Indian Institute of Technology, Kharagpur, and MBA from INSEAD, France. Welcome, Rutvik. It is great to have you here. And over to you if you want to make some introductory remarks before we begin with our conversation on the VC industry and the ecosystem and your experience and learnings.
Thank you, Pankaj. Thank you for hosting me and giving me this opportunity to speak to the audience of CFA, and not only from India, but from across many, many countries. It's definitely my honor and my pleasure to be here with you today. And thanks for the grand introduction. Really appreciate it. And as Pankaj mentioned, I'll also briefly introduce my firm and what I do. Largely for the last decade plus, I've been part of the Indian internet ecosystem as an investor. We are an early stage venture capital firm. We invest in fast growing tech companies at the very, very early stages, and hopefully, hold on to them, work with those founders for 7-8 years, and hopefully some of them become big and deliver huge returns, not only for us, but also for our investors. So that's a very, very brief background about what I do professionally and why I'm here today. But would happy to be here and speak with all of you and have a conversation around venture capital and investments in India in particular.
Thank you so much, Rutvik. Let's begin with how do you see the current landscape for VC investing in India, and how do you see it evolving over the next few years?
So let me, I'm in the business of venture capital, which is the business of optimism. I'm an eternal optimist, and I would have not chosen this career path had I not been an optimist. So if you ask me, how do I see the ecosystem today? A very short answer would be that I'm more optimistic than ever. But let me elaborate a little bit on what I mean by why I'm more optimistic than ever. So there has been, over the last 10 years, we've seen many, many, many changes that happened in the ecosystem. And I'll kind of point to maybe two or three changes which make me believe or which lead me to this optimism that I'm seeing there. Three things. First and foremost, for a successful venture capital ecosystem to happen, you need what is known as the large supply of entrepreneurs, large pool of young people who are ambitious, who are driven, who are talented, and want to change the world and want to make something big. And what I've been seeing is nothing more than dramatic in terms of the ambition levels today of most young people. And let me give you a few very specific examples of that. Pankaj and I happen to be, have studied in the same institute many, many years ago, almost 25, 30 years ago. And when we look back at our days in that college, it was an engineering college called IIT Kharagpur. Probably 60, 70% of our graduating class, ended up going to US, doing their masters, and many of them have stayed back in US. And today, I think both of us can probably say that we have many more batchmates living in US than what they are in India. Now, fast forward 25, 30 years back into it. Today, those numbers look very, very, very different. I would say less than 10% of that class probably goes out and to US or wherever. The majority of them, 90% of them, are staying back in India. Now, when they're staying back in India, what exactly are they looking to do? What are they planning to do? And that's where the optimism comes from. You ask most of the people, and they will say their ambition is today to either be a startup entrepreneur at some point in time, and if not immediately, maybe take up a job in one of the startups. The first choice of employment is no longer a Google or a Facebook, but probably a fast-growing startup in Bangalore. And that is where the ambition levels have changed. That is where the desire has changed. That is how the role models have changed. And what that tells me is that over the next 5, 6, 7 years, you will see many, many, many young entrepreneurs come in and trying out new ideas, building new products, wanting to change the world. And that creates a massive opportunity for venture capitalists like us to invest in them and hopefully grow the market. And I think most of us can vouch over here that in the last 10 years, our lives have fundamentally changed. We use very different set of products and services like Zomato, Swiggy, Uber, Amazon, Flipkart, everything compared to what we were doing 10 years back. And next 10 years, you'll again see a similar set coming out, largely because of the way the entrepreneurial ecosystem has changed. Second factor which has changed and which brings optimism is flow of domestic capital. 12 years back when we started this venture capital fund, 100% of our money came from outside India, largely North America markets. So it was foreign investors who were fueling the Indian venture capital and including the stock market at that point in time. And many of you probably know the data that in the stock market today, a large number of investors are domestic investors, largely coming through SIPs, mutual funds, which is driving the markets. Same thing is actually happening in the venture capital world also. Large number of investors today, funds like ours, have 60, I think I can tell you specifically for our fund, 67% of our fund is domestic money, which means it is capital coming from India, investing in Indian growth. Returns will be kept in India and recycled back into India, leading to a massive multiplier effect that you'll see in the next 10 years. So these are the two very, 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 hidden trends which you will not see in any macro numbers. We all know about, Indian macroeconomy going to 5 trillion, this, that, etc. I'm keeping all of that aside because most of us in the audience, I'm assuming, reads newspapers and sees those numbers. But these are very, very anecdotal pieces of data which are hidden 10 layers beneath, and which is what drives optimism. And third, piece is that macro trends are in favor. Hopefully, we'll have political stability. Hopefully, we'll have economic liberalization, economic policies which are more favorable to businesses over the next 5-7 years, and that will all drive growth. And that's why I'm optimistic, Pankaj. So if you ask me, what do I think about venture capital at this point in time? You have to be an optimist to be in this career, and that's what drove me. But here are the 3 specific reasons which drives me towards optimism, and probably be more optimistic than what I was 10 years back about the opportunity set today.
That's amazing, Rutvik. Thank you so much. I think I couldn't agree more, because like when we look at some of the changes in public markets,
Yeah.
Like we have almost $2 billion of SIP inflows every month.
Yes.
And like I do remember that there was a time when like long back, almost 20 years back, we used to worry about like what happens to the markets when FPIs or FIs start selling. That fear is gone, completely gone.
Exactly.
Like people are not worried anymore, because there is enough domestic money, even retail money. So like the numbers have been mind-boggling. So thank you so much for highlighting that. And I do agree that optimism, like whether you're an investor or whether you are an entrepreneur, or even in general, like that's something which is like, that is what the human race survival is dependent on. Like we're not optimistic, you are in trouble, actually. Thank you so much. So let's move on. In your view, what has changed in the industry over the last 5 years? Because COVID was such a massive disruption, it was such a massive impact. And a lot of things changed, like the people's priorities, the way they used to do things and all that. Like maybe work from home is a good enough example. It's not a luxury anymore. Like people see this as a requirement, or maybe hybrid culture. What do you think that this has done to impact the current set of ventures? Or maybe like, how do you evaluate the ventures? Like, is there anything which has changed in terms of when you used to do that 5 years back before COVID, and now when you do that post COVID? Is there anything which has impacted the decision making, the entrepreneur's mindset, the mindset of VCs? Is there anything you want to talk about on that?
So, no, absolutely. So I would say that this has been a trend, not only COVID, but if, over a 10-year trend over the last 10 years, there have been 2, I think, mega events that have happened in the Indian ecosystem, which have led to a massive acceleration or the change in something that we've seen. And I'll throw in some data and throw numbers. In my introduction, you mentioned that I used to work for Google before I got into the investing world and things like that. I quit Google in 2010. At that point in time, iPhone and Android had very, very limited, were very new in India, had very limited penetration. And we knew the exact number of people who were on the internet in India. That number, when I quit, I think was either 65 million or 75 million users on the internet in India. And that included broadband, data, everything put together. And on a population of 1.2 billion at that point in time, we were at 65, 70 million. Today, in a span of 10 or 12 years, we've grown from that 60, 70 million users on the internet to 800 million plus users on the Indian internet, consuming all kinds of services. It could be consuming services, consuming content, consuming whatever you can think of. And that's a massive growth that has happened. And that was fueled or accelerated, with Jio coming in 2015 and saying that, hey, data is now whatever, 100 rupees a month or 200 rupees a month, and slashing the prices completely. So that was the first, I would say, an inflection point that led to this acceleration. Second inflection point was the pandemic that you see. The pandemic fundamentally changed the behavior of all of us in a way that we started consuming, or became, even those people who were not comfortable with digital services or were not digitally native, fundamentally were forced to change their behavior and started adopting more and more digital services. So these were the 2, I would say, events which catalyzed the opportunity set for us. So that is from a venture capital investor, when I'm evaluating businesses, that is one set of one of the things, two things we look at. Any product and service that we are looking at, we are trying to estimate the market opportunity of that product and market opportunity of that service. These factors have played a big role in how we look at the market opportunity and how we look at the market service. Most of these products do not have a market. The companies we invest in are going to create the market, or they're going to expand the market in. And so these factors have come. And the second set, which we think about, is what Pankaj, you spoke about, was the participation or the Indian domestic stock markets or the public markets. Eventually, we all need to exit at some point in time. So from an exit perspective, 7 years back, pre-COVID, I think most of us were not factoring in that companies will go public in the Indian market. But 2021, I think we saw the first 6 or 7 venture-backed companies go public in the Indian market. There was Zomato, there was Paytm, Policy Bazaar, Delivery, and maybe 2, 3 more. And that has again fundamentally changed. Of course, it has brought in huge amount of learnings, both for entrepreneurs and venture capital investors in terms of how to build companies in India. How are they different from NASDAQ and Silicon Valley based companies? And we can talk about some of those things. But that's the other factor which came in during the COVID, that, hey, yes, Indian consumers have changed, Indian public markets have changed, and hence we react and adjust accordingly.
I think that's amazing, because like the numbers which you talked about, like from a 65, 70 million to 800 million. And I think a lot of it has led to changes probably were very difficult to expect. Like somebody like Trent, the growth for them in their tier 2, tier 3 town focused venture, Zudio, which was started like 7, 8 years back,
Correct.
is far more from, let's say, they have more stores than West Side has. So imagine like in 7 to 8 years, tier 2, tier 3 city focused venture, which was very independent in that sense, has grown much faster. And look at the stock price impact it has done on Trend. So I think I completely agree. Like this is something which is a fundamental change, and the way aspirations have grown, even in smaller towns, smaller cities, creating a big market. So
Right.
like, of course, we talk about a lot of these sectors, and of course, you have the best seat possible in the arena. Do you think that currently, of course, there are sectors where you will see maximum traction, but are there also hidden opportunities with significant potential? Maybe the VCs are ignoring, they are not focused on that. Do you want to talk about that? Is there something which you specifically think is very important for all of us to know about?
Yeah. So I think if I were to look at, most of us look at the obvious trends that are happening, and that those are things which probably captures the first page news and Economic Times or whatever. Zomato doing something, Uber doing something, Ola doing something, huge wave in AI companies, and so on and so forth. But if you were to dive deeper into some of our portfolio companies, including ours and maybe some of our peers, there's a silent movement happening in India at this point in time, which is very different from the set of companies which were happening 5 years ago or 7 years ago. Let me think of how to explain it. So all of us know that from a manufacturing capacity perspective or capability perspective, China is way, way, way ahead of India. And we have a lot to catch up, both in terms of capacity, quality, all of those things. And very unlikely we'll catch up in the next 10 years. But there is a very different kind of manufacturing that has started happening over the last few years. And in particular, I think India has that opportunity to become a leader on that. And those are the products which have a combination of a lot of hardware and software. And I'll give you 2 or 3 very specific examples. I'll give you one specific example from our own portfolio company, and I think that illustrates the things. So we have invested in a company called Blue Armor, which is trying to make smart helmets. Now, as you know, India is a large two-wheeler market. We sell probably 100 million helmets every year out there. Almost everybody who rides a two-wheeler needs to buy a helmet and things like that. And helmets have remained the same for, several years, several decades. When you compare a motorcycle or a two-wheeler rider with a car rider, the experience that the car rider today gets is very different from what they were getting 20 years back. A car dashboard has become completely digital. A car dashboard has digital entertainment built into it, navigation built into it, voice command built into it, all of those things built into it. Why can't a two-wheeler rider get the same experience today? No, you can do it if you make your helmet smart enough. If you integrate electronics and software into your helmet, you can do exactly all of those things. Now, in order to build that, you're riding on two trends. One is the availability of cheap sensors. So let's think of a simple smart helmet. A smart helmet which user is riding, and in your scooter, you press the right indicator button. There could be an indicator on the helmet also, which simultaneously starts flashing that I want to turn right. When you're pressing the brake, there could be a light on the helmet which turns on. There could be the helmet could have a sound system and a voice system with which you can now interact with your phone and say, okay, turn on navigation for me to go to point A, point B, and you are now having that conversation in that. You're listening to music while you're in your through your helmet with absolute noise reduction and sound clarity that you would get inside a car. So all of the same experience that you get inside a car, you could start getting into a helmet. And that is enabled through a combination of very, very, very cheap sensors or electronics sensors, and bulk of the magic sits in software. What has happened in the world in the last 20 years is that the price of sensors have started, just like how the price of computers have fallen down and the price of mobile phones have fallen down, the price of sensors have fallen down almost at the same rate. That means sensors have been commoditized. China, Korea, Taiwan, those are the countries which are making those sensors. We can buy those sensors very, very cheaply, be it an accelerometer, gyroscope, whatever you want to call it. And put all the magic and all the value in the software, which is driving the value and can capture value into those companies. And you're seeing a very early stages of this revolution happening in Indian startups. There are companies which are trying to build these smart helmets. There are companies in robotics. There are companies in space technology, a whole bunch of stuff that are trying to do. But there's only one common thread between them. They're all leveraging. We cannot compete on manufacturing with China, but we can buy cheap sensors from everywhere, build a software layer on top of it. We are better at software than most other countries and drive value at it. So it's a very different kind of manufacturing that you're seeing at the early stages. This is an industry which is 2 to 3 years old, but if it takes off, I think India as a country will not necessarily need to follow the same manufacturing path which China took. It's a different kind of manufacturing where we are leveraging our strengths, which is in software and those kind of value-added services, and build on top of it. So that's a trend which is very hidden, very under the radar, but an opportunity right there for many of us to take advantage of.
Thanks, Rutvik. That was an amazing example. Like, just out of curiosity, how much will that helmet cost? Because it will be catering to a market which will be slightly more price conscious.
Correct.
So
it is, as of right now, I think it is a typical helmet. If you buy, that Vega or a stud helmet or something, I think they cost somewhere around 800 rupees. The smart helmet today, I think, is somewhere around the 2,200 or 2,400 rupees. So it is 3 times more expensive. So penetration will take time. But this is early days. As these products start scaling and start building, I think it will probably come down to a price point of 1,200, 1,300 rupees at some point in time as it starts scaling. But that's where it is.
Yeah, that's extremely competitive, because if you would have asked me to take a guess, I would not have guessed less than 4,000, 5,000 rupees. Yeah. But 2,200, 2,300 is extremely competitive price. And as you rightly said, when the prices fall, and even if somebody is looking for a better experience, and the guy can spend, like maybe somebody who's riding a Royal Enfield Bullet, like for that person is not too much money. 2,200.
Exactly. Yeah.
Right. Let's look at something which is, and you touched upon this, that India is a very different market as compared to US or maybe a developed market as such. And a lot of people say that access to easy money harm the Indian entrepreneurial ecosystem, and the template which was borrowed from the US was not actually suitable for India. What's your take on this?
No, I think there is some truth to it. I think what happens with India is that in the short run, we all end up overestimating what the Indian market is, what the returns from the Indian markets are going to be, and underestimating what happens in the long run from what the Indian markets will deliver, right? And you can look at the last 10 years and you can quickly see that how things have changed. But in the short run, we always overestimate the market and expect it to behave like Silicon Valley and expect it to behave like NASDAQ, and which doesn't happen. In India, all said and done, it's a shallower market. Our per capita GDP is still at what, $2,500 or $2,700 compared to US at $60,000-$70,000 per capita GDP. So there will be inherent differences on those markets, but some of the investors and because flow of capital is global, you tend to start expecting those similar behaviors, and that creates irrationality in the thing. But having said that, my job title is a capitalist, and what I've learned to understand over the last so many years that in capitalism, sometimes irrationality is good. It is the best form of Darwinism or evolutionary, where the irrationality leads to creation or an explosion of new ideas, new products, new services, new stuff. And at the same time, capitalism forces things which are non-sustainable to eventually die and leads to the survival of the fittest. So this whole cheap money, free money, it keeps going on cycles. So there'll be a cycle of cheap money, free money. It'll lead to an explosion of products and services. Some of them will never make sense to anything, but it is Darwinism. Let everybody create. Nobody has a crystal ball. Nobody knows what's there in the future. Something will emerge out of it, and the fittest will survive out there. So that's the way we look at it. This is a view which is very different from most other investors. Most other investors suffer from loss aversion, which is one of the big biases which we have. And a key criteria to a successful venture capitalist is that the first thing that you have to learn is to overcome this particular bias of loss aversion. Loss is okay. Loss is absolutely okay. You are in the world of accelerating Darwinism, where you let multiple things create. Some species will survive, some will die, and that's okay.
I think the word which you used, loss aversion, right?
Yeah.
So this reminded me of that book, Thinking Fast and Slow, from Daniel Kahneman. Like he said that 100 rupees loss is equal to 200 rupees of gain in terms of the impact it has on you. So
Yes,
loss
absolutely.
aversion, like that's something which is, of course, as a VC investor, you should always be prepared for it. And I'll probably extend this thing. Last couple of years have been great for public markets as well. So like India, the headline index is up 25-30% in last 1 year. Small mid caps have done 75 to 100%. Like if you look at anything which has done 75 to 100% is not considered a great investment. People are expecting 3x, 4x return in a matter of 18, 24 months. So what that has done to the fund availability? On one side, you said like there is more domestic money available, but in terms of the threshold, in terms of the returns expectation, does it create more pressure on VC firms to invest and deliver the kind of returns which people would be expecting because the public markets have been doing so well?
Yeah, no, you're absolutely right. I think the pressure on us. So let me take a step back. A venture capital fund, unlike a public market, where you can enter the public market at any point in time and exit the public market at any point in time, an investor who's investing in a venture capital fund is investing in a highly illiquid asset. Most funds are of a 10-year lifetime. So when we go to SEBI and register our fund and say, hey, here's this AIF, the life of that AIF is 10 years usually. Most of the time, so the investor who comes in, we tell them that, hey, your whatever money that you're investing in it, please forget it for the next 8, 9, 10 years, because you're not going to see anything back. We take that money, create a portfolio over the first 3, 4 years of the life of the fund. Some of those companies work out, some of those companies fail. The companies which work out and become big, they will take 6, 7, 8 years to become big and eventually deliver an exit. So your cash returns start only at the 8th, 9th, and 10th year of the fund. So it's a very, very illiquid asset from that perspective. So if I were, and very, very risky because you're investing in startups which have a high mortality, high failure. So the premium that an investor expects on a venture capital fund is to the order of 5 to 8 percentages above what a public market would give you. So hence, the pressure to deliver those returns is very real. The incentives, I make money only when my investor makes money. If my investor does not make money, I don't make any money. That's how the incentives are structured. So yes, the pressure is very, very real in terms of aligning that kind of illiquidity premium, risk premium that you may want to give on this asset class.
Thank you, Rutvik. I think that's something which is important. How do you think it will play out? Because public markets always operate in cycles, and that will be applicable to VC returns as well. So you think that the kind of I would not call it completely irrational, but there is certainly some exuberance which is there in public markets, and you think that it's going to probably subside in a while, or you think that we are in such strong tailwinds we have in the macro opportunity and macro economy that this is going to continue? Like, what is your personal sense on that?
The reality is none of us have a crystal ball as far as predicting capital markets are concerned. We can only always look back. So it's impossible to time it, right? Nobody knows the timing or the impact of slowdown or growth that may happen. So impossible to time it. But what the past tells us, we can look at markets everywhere in the world over the last 15, 20, 30, 40, 50 years. We have all that data with us. And if you look at any 10-year period, any rolling 10-year period, it is always cycle. There are always multiple cycles that happen in that 10-year period. Today, if you were to look at the public market from a very narrow point of view for the last 2 years or last 3 years returns, it will look like the public markets are giving me 20% returns, on an average. Of course, there will be some stocks which have been multi-baggers, but on a basket of portfolio, a public market would have given you 18-20% return. But in the history of stock markets, anywhere in the world, including India, any rolling 10-year period has never given you 20-year returns, right? On an average, the S&P index in US is somewhere in the 9 to 10%. India is somewhere in the 13, 14 odd percent range as far as that is concerned. So I don't see why over a rolling 10-year period, we would be any different. Of course, our macro tailwinds are better. So that 14% may move to 15%, maybe move to 16%. But on a rolling 10-year basis, that's where I would assume the numbers would be. Now, when will the tide change and when will the tide move back or move forward is anybody's guess. No, we don't have that crystal ball. Unfortunately, I wish I had. Then I would quit everything else and bet all my money on that.
That's so amazing, Rutvik. Like, I can clearly sense that no matter how good you are, but some of the calls will go wrong. And you use this phrase, none of us have that crystal ball, like 3 or 4 times in half an hour. Does it mean that VC investing teaches you a lot of humility?
Absolutely. I think if you're not humble, if you're not grounded, you will never succeed in this business. I think the first thing to understand and realize, there are 2 parts of the VC business, right? One is picking companies, and the second part of the business, which again, which is hidden to most of the people, is that once you made that investment, you usually sit on the board of that company and you start working with those founders and work with them for 6, 7, 8-year period to make that company grow, to govern that company, give directions to that company, to bring it to where it is. And in that journey, there are multiple stakeholders involved, each with different incentives. There may be investors who came earlier than you. There may be investors who came later than you. There may be investors with different time horizons in their mind. There may be the founders have a different point of view. The management has a different point of view. All of these stakeholders are driving the company in different directions. And the only way to build consensus and continue growing the company is to put your ego aside and build consensus around the table and doing what is right for the company. And that teaches you humility. That keeps you grounded. And that teaches you that, oh yeah, there are so many things that I don't know in life. There are so many things that I don't know about. The founders, they eventually the expert about the company. And that is a key skill. And that, if you ask me, that is what differentiates a good VC from a bad VC. It is not about picking the companies or picking the investments. It's about what you've done after picking those investments.
Well said, Rutvik. What is the framework you use? Not I mean you, but like VC firms in general, and in different, but like what increases the chances of getting funded, or tangible or intangible things which VC firms look at? Any non-negotiables in the personality of the people who are running the business you would look at? Of course, transparency, honesty, all those things are well accepted. But is there any specific thing which you want to mention, which you want to share with the audience?
So I think few things when a founder comes to us, with a plan, and I can tell you, in my 12 years of history of venture capital, having funded many, many, many companies, there's only one company where everything worked out as per the plan that was presented at the time of pitching. In every other investment, whether it has been successful or a failure, the journey of the company has been very different from what it was pitched. So that's the reality of our business. So now, which means I need to adjust myself during the evaluation criteria to and assume that whatever the founder is pitching is most likely not going to work. It's going to be very different from them. And hence, I will look for various traits in that founder. Of course, transparency, honesty, deep knowledge on the product, deep knowledge on the market in which they're building a business, all of that is given, but it is the softer aspects. The softer aspects are, do you have very deep insights? Are you really, so emotionally married to that product that you're building? Or are you emotionally connected or driven by the problem that you're solving? There's a very big difference between the two of them. And most of the times, the product evolves through the journey of the company, but the problem remains the same, and the product becomes iterative in nature. So that's a trait that a founder needs to have, that they need to be wedded to the problem and not the product. The other thing is, as I said, because of the companies, rarely work out as per plan, agility to understand what is going on and constantly readjust your plan, readjust your strategy, readjust your products is a very, very, very important trait within the founders. So that's the other thing that we look at. The third thing, and this is where we usually, it's very hard to judge. And when we look back, most of the mistakes that we made are probably in this third factor. If you think about the journey of the company, at the time of our funding, these are startups, these are early stage companies. They at best have 10, 15 employees, 20 employees at best. But if it becomes successful and it becomes a large company, they probably have 1,000 employees by the time they grow. That means in a very short period of 6, 7 years, this founder has to grow from managing 10 people to scaling an organization of 1,000 people. And those are, trust me, those are very, very, very different skill sets from, working with a set of 10 people versus managing a company of 1,000 people. Can this entrepreneur grow at a rate faster than at which the company is growing, so that at some point in time, they can become effective business leaders who can manage an organization of 1,000 people? It's a very difficult answer. We use our judgments at that point in time. And more often than not, sometimes we go right, sometimes we go wrong over there. But if you look at our failures, most of the failures end up over here, where the companies are not able to scale effectively because of all these reasons. Scaling is hard.
I think that brings me to my next question. Of course, failure will be a harsh word to use, but what can entrepreneurs and VC firms learn from some of the examples like Byju's, or maybe like challenges which Paytm has been facing? Any specific takeaways? Because you said like 32,000 and changing the orbit, transitioning to a larger company is the most challenging thing, is the most difficult thing. Anything which entrepreneurs and VC firms can learn from some of these examples, which have happened unfortunately in Indian market as well?
No, I think intellectual honesty is extremely important. The reason why some of these companies have, happened where they are is both founders as well as some of the investors in these companies, they had, blinders on. They were not intellectually honest to themselves that, hey, the business is not fundamentally sound, the business is not sustainable, but you live in this delusionary world, everything is great, everything is great as long as, we dress it up, we will raise some money, and you end up in this what is known as the greater fool syndrome, that, today I'll dress it up, I know things are not right, but you get into this make believe world that everything is good. You find the next fool, sell it to him, and somehow some of these companies are able to do it for 7 8 times in a row. Then you start believing that I am God and I'll always find the greater fool at any given point in time. But unfortunately, there are only limited number of fools in this world, and at some point in time, the music stops. And that's exactly what you're seeing in some of these companies. And that's so intellectual honesty, I think, is the key learning, is the key learning for all these things. If you are intellectually honest and say that, hey, realize that, hey, the business model is not necessarily sustainable, you should stop sooner rather than dressing it up and keep continuously finding the next, the greater fool.
There are so many questions in the questions queue
Yeah.
from the audience, but
Yeah.
I'll just ask one last question from my
Sure.
side. Rutvik, you have a very interesting career path and you made a very successful switch from technology to investing. I'm not saying that only you have done that, but a lot of people, and there are very famous examples as well. Which are the factors responsible, which prompted this? Like, what made you switch? And would you have done anything differently if you can now rewind the clock?
No, I think I would have not done anything differently. Let me tell you, I really, I think, enjoy this career, and that's why for the last 12 years I've been in this. So two things. I think I am fundamentally an engineer at heart. I still love technology. I'm still keep dabbling with a lot of the new stuff that happens specifically in the world of technologies, be it AI, be it, whatever it may be. So I am that at heart. That's the first part of my personality. The second thing, which I learned is that I'm one of those who enjoys breadth. So if you are a startup founder or if you're working for a large company, you go deep into one very specific subject. Whatever you're working on, you go very, very deep into it. And at some point, and I think it was Google where I experienced it for the very first time, is that Google in that 4 year period gave me amazing breadth. Google had all kinds of products: Google Maps, Google News, Google Gmail, search, ads, a lot of those things, and it gave me exposure to that breadth of learning different things and getting knowledge about different things in a very short period of time, and all within the technology domain. And so I kind of liked it, really enjoyed it. And that helped me kind of say that, hey, maybe investing is a career. And I didn't really think so much about it, but I thought it from a perspective of breadth, that the VC job will give me this breadth because I'm constantly talking to new founders, new ideas every day. I'll enjoy that. So that's how I got into this. But then, of course, there's a lot more than this. Is just one aspect of me which keeps me intellectually going. And then there are many other aspects of the VC business, which also I kind of enjoy and then I end up liking it.
Thank you, Rutvik, for sharing. We have a question from Darshan Patel.
Yeah.
And he wants to know, how do you value the very early stage companies which are yet to start generating any revenue?
Yeah.
And I looked at your website, you said like from whiteboard to the IPO.
Yeah.
So you are the right person to answer that question. And how do you think that this plays out in the Indian context?
So, okay. So this is the biggest mystery to most people, that without a balance sheet, without a P&L, how am I giving somebody a valuation of $10 million, $12 million on what basis? So let me kind of demystify it. The way we work is that we work backward. So let's say you were to come to me with a business idea or a business plan and say that, here's a product that I want to build, and here's the the market that I'm going after, and here's what the economics of this business are going to look like. We're going to take that plan, try to understand the product, try to understand the market, and then we will, alongside with you, and based on inputs that you've given, try to get a best estimate of what it will be 5 years down the line. Is it going to be 100 crore business? Is it going to be a 500 crore business? Is it going to be 1,000 crore business? Whatever it may be, we try to arrive at that estimate. And then at 5 years down the line, whatever its business model is going to be, business size is going to be, we will estimate, okay, if it's a 1,000 crore business 5 years down the line with this much growth rate and this much profitability and this much EBITDA, what kind of market multiples will I get and what its valuation is going to be? And say it turns out that, okay, 5 years down the line, the business is going to be a 5,000 crore valuation. Now, I will start working backward from that. What I do know statistically, that if I make 10 investments, 4 or 5 investments do not work out. They fail. They go down to 0. 2 or 3 investments give me 2x, 3x return on my capital invested. But there are 1 or 2 investments which give me a bumper 15x, 20x return, or at least a 10x return on them. The only problem is at the time of investing, I don't know which one of these is going to be 10x, which one is going to be failure. But as per the plan, everything should give me 10x. There should be a feasibility of that company giving me 10x. So that's what I'll say. Oh, okay. 5,000 crore valuation. I want to make 10x my investment. And if I own 10% of the company, that means I will make 500 crores of revenue at exit on this thing. So a 50 crore investment at this point in time, if I give to own 10% of the company, I will make, or to own 20% of the company today, I may make 10x my money. That's the way we arrive at it. And that's the way we determine the early stage valuation. It's completely by working backwards. So it's a big guesstimate that we do. And most often, the numbers are very, very different from what we estimate at the time of early on. But so sometimes some of them end up giving us 20x, some of them end up giving us 5x, and many end up giving us 0x. So that's what it ends up at.
That's amazing. There are a lot of entrepreneurs complain that whenever you meet a VC, they will say that, do you have any other commitment? So like somebody will expect that at least one person has done that hard work, that
Yes.
commitment has come in,
Correct.
and then I will start evaluating.
Yeah.
But anyway, there is next question
that's the VC business is no different from any other capital market where herd mentality drives. Is a part of the, I think, cognitive biases which every investor faces, be it public market, be it VC investing, be it real estate investing, whatever it may be. If everybody else is doing it, something must be good in it. Let me also do it.
You talked about that greater pool theory, right? Like you're expecting that somebody else will come in and pick up that stake. Yeah, right. The next question is from Amar Bhagwani, and it's very specific. Like the question is that Uber is making so much of losses, and still it's valued like such expensive valuation. So what's happening here? That's the question.
I wish I knew the answer. So I think the reality of these businesses, as I said, at early stages, I know that these companies are making losses. They're not cash flow positive. But, at least when we make the plan, there is a hope that at some point in time, they're becoming a sustainable business. And at sustainable business, this is what the size will be, and that is what the valuation is going to be. So I'm going to, what they call is forward price it. I'm going to pay you for that potential future when you're going to be sustainable and at that valuation right now, because I know that there's a feasibility for sustainability. So present cash flows, it's less about the present cash flows and more about what the potential future cash flows are going to be of the company. And that's where it's your guess versus my guess versus somebody else's guess. And hopefully it's a public company, widely traded stock. So wisdom of the crowds must be arriving at it and in some way at the right number.
Thank you, Rutvik. This is from Devansh Modi. How does VC community deal with or embrace developments in AI and how it has affected the decision making? And will AI be able to better model failure or success?
So we don't know. There is a chance that AI will disrupt the VCs themselves. You will not need VCs to evaluate any business plan, any entrepreneur, any of them. But my guess is that by the time that happens, I'll be old enough and I'll be retired by that time. Today, at least today's AI is still in its infancy as far as evaluating a lot of the softer aspects are concerned. And as I said, the VC business, there are two evaluations which happen. One is the harder aspects of the quality of the product, type of product, what market is going after, estimating the market. And there, I think we would all welcome AI to come in and help us. The other aspect of the VC business is the software aspect, judging the entrepreneur and judging the entrepreneur's ability and capability to build the business, grow the business, scale the business. And that is a very, very, very softer skill, which some of us have learned over a period of time. And the third part is this whole stakeholder management and different incentives. My guess is AI will play a role in the evaluation of markets, products, business plans, but the software aspect, at least in the foreseeable future, I think is still going to be a person-to-person business.
Thanks, Rutvik. There is a lot of interest in your career, Rutvik. Like somebody is asking me that, or rather asking you that, how did you make that transition from Google to VC investing? Somebody like there is Prerak Gandhi, and he wants to work with you on some of the projects. A lot of interest in working with you and in your career. So I think it's pretty interesting insight which you are sharing, and maybe audience is just loving it. The next question is from Siddharth Jain. Okay. Apart from technology and AI sector, which are the other industries VCs are looking at for investments in India today?
So I think I would say with a broad definition, it is still largely technology. And within technology, it can be AI, it can be software as a service, it can be consumer internet companies, a whole bunch of things that are happening within technology. Now, many people ask and tell us that, hey, you guys are biased, you're not investing in this manufacturing company, you're not investing in this potato manufacturing company, or whatever it may be, and you're only doing internet. The answer to that question is a little bit structural. The way a VC fund is structured, as I state, that it is a 10-year lifetime fund and a high-risk fund. That means that every investment that we make has to be able to grow 10x, 12x in value over a relatively short period of time, which is 5 to 7 years. At least as of right now, I don't know of any sector apart from technology which allows you to scale a business rapidly in that short 5 to 7 years. If there were a business which will come to me which can scale rapidly in a 7-year time frame, absolutely. I'm not married to technology for that perspective, but technology allows you to reach to a much larger user base in a relatively short period of time and scale those businesses, and hence we end up picking those businesses. It's not that we have something that we don't like about other businesses, but that's the way it is.
Okay, so the next one is from Sampada Suresh Dali. How many ideas were pitched in to you in 2023, and how many of them did you?
Approximately 1,500, and we ended up doing 4 or 5.
Oh,
yeah. So it's a very, very it's tougher than the IIT JEE exam.
That's a nice one. And what differentiated these 4 or 5 ideas? I know that this could be different from one to another, and you will look at maybe one company in one space, but anything which you distinctly remember or can highlight to the audience that these 4 or 5 ideas were different from other 1495 or 1500 ideas, and what made you invest in them?
So to be honest, I think even if you look at 1,500 of them, I would say at least 80 to 100 of them are actually fundable, are actually good businesses, are actually good ideas. It is our own inability to sometimes the size of our fund, the size of our team, all of that adds a constraint into how many we can do. So we are a 1,000 crore fund. We have to do 15 companies in a 3-year period. So that means I can do only 5 or 6 investments per year. That is what is mandated, and hence I end up doing 5 or 6 investments per year. But 70 to 80 of them, or maybe 100 of them, are actually fundable. A lot of them boil down to very, very small-ish, things, and those are very judgmental, subjective calls that we take as to why one person and why not the other person. All the 100 of them that we would have, remaining 100 that we would have seen and not done it, very likely somebody else would have done it. There's a little bit of a beauty lies in the eye of the beholder kind of a syndrome here also.
Right. There is a specific question on EdTech. In this sector, maybe like Byju's has created a situation where like VCs are kind of not interested in the space. But do you think that is there anything which an entrepreneur focused on that sector can do to make VCs invest in him or her?
No, I think so. Most VCs will evaluate the business bottom up. And I think the Byju's sector has created, or the EdTech is less to do with Byju's than more to do with consumers choosing not to, or customers having a little bit of a fatigue from online education technology in the post-COVID world, and going back to more traditional ways of coaching, more traditional ways of learning, than to do with what Byju's has happened. Yes, what happened with Byju's? It's unfortunate. These things happen, but that is not an indicator that it will not that sector becomes uninvestable. What has happened is consumer behavior in that sector has changed, and hence we kind of the funding in that segment has changed, has reduced.
Gaurav, Pradeep, Sonon, he wants to know, do you have any advice for people trying to get into a VC role at this stage, or like anything in terms of you want to share with somebody who is trying to break into this industry?
So my advice would be, VC is a very, very small industry. Unlike consulting firms, accounting firms, etc., or a KPMG, we do not. This industry does not hire in large numbers. It's a very, very small industry. So breaking in is a lot of it is serendipity. A lot of it is the right place, right time. But a good way to do it would be to start working at startups, get operational experience, real world experience in terms of working at some of these early stage startups. These early stage startups will bring you close to the VCs in terms of not only knowing how they work, but also actually interacting with most of them. And once you do that, you will get to know which firm is hiring, which firm is not hiring. Most of us do not advertise when we are hiring. We usually end up hiring from the network, from the set of people that we know. And that's how, that's a one good way of doing it. Join a startup first, and then a right place, right time will end up happening if you're determined to make it happen.
Thank you, Rutvik. Like